Welcome to the Riskwiser Zone, the show where we dive into the world of stocks and finance to help you make informed decisions about your investments. I'm your host, Lewis, and I'll be guiding you through the latest news and trends in the financial sector. Today we're starting with a story that's been making waves in the tech industry. Nvidia, the artificial intelligence chip giant, has been named as Wall Street's favorite stock to kick off 2026. According to analysts, the average price target for Nvidia implies a 38% upside, with some even predicting a whopping 92% increase. But what's behind this optimism, and can Nvidia really live up to these lofty expectations? As we take a closer look at the numbers, it's clear that Nvidia has been on a tear lately. The company was the second strongest performer in the so-called Magnificent Seven group of tech stocks in 2025, trailing only Alphabet. And with its general-purpose graphics processing units still offering the most cost-efficient way to run AI models, it's no wonder that analysts like Evercore ISI's Mark Lipacis are bullish on the stock. But not everyone is convinced. Some experts are cautioning that the AI sector is shifting towards custom chips, which could challenge Nvidia's dominance. Additionally, hyperscalers like Amazon and Google are expected to ramp up their own chip operations, potentially posing a problem for Nvidia. So, what does this mean for investors? Should you be buying into the hype surrounding Nvidia, or is it time to take a more cautious approach? We'll be exploring these questions and more in the coming segments as we delve deeper into the world of tech stocks and beyond. We'll also be taking a look at some of the other big players in the industry, including Microsoft, Apple, and Amazon. From earnings reports to market trends, we'll be covering it all on the Riskwiser Zone. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone, where we're diving into the world of AI stocks and exploring the latest developments that could impact your investments. Today, we're taking a closer look at two companies that are making waves in the industry: Super Microcomputer Inc. (SMCI) and Dell Technologies Inc. (Dell). Goldman Sachs has recently initiated coverage on both stocks, but with differing opinions. For SMCI, analyst Catherine Murphy has given the stock a sell rating with a 26 price target, citing ongoing margin pressure and limited visibility on profitability despite the company's AI server leadership in Tier 2 cloud markets. This is a significant downgrade from the previous target of $34, reflecting concerns about the company's ability to maintain its margins in the face of increasing competition. On the other hand, Goldman Sachs has initiated coverage on DEL with a buy rating and a price target of $165.14. The firm believes that Dell continues to be an AI winner, driven by cyclical recovery tailwinds in its core data center hardware business. This momentum is expected to support upside despite near-term headwinds in the PC market. Now, let's take a step back and consider what this means for investors. While SMCI may face challenges in maintaining its profitability, Dell seems to be well-positioned to capitalize on the growing demand for AI servers. However, it's essential to remember that the AI stock landscape is constantly evolving, and what may seem like a sure bet today could change tomorrow. As we always say on the Riskwiser Zone, where do you stay your money Monday? It's crucial to stay informed and adapt to changing market conditions. While we acknowledge the potential of both SMCI and DEL as investments, it's essential to consider the unique risks and opportunities associated with each stock. In conclusion, the AI stock market is a complex and dynamic environment, and investors must be prepared to navigate its twists and turns. Welcome back to the Riskwiser Zone, folks. As we wrap up today's show, I want to dive into a fascinating tale of two energies: natural gas and nuclear power. It seems like the abundance of nat gas supplies is putting pressure on prices, while the Trump administration is sticking its neck out to promote energy production. According to recent reports, abundant U.S. supplies are weighing on nat gas prices, with storage levels 3.4% above their 5-year seasonal average. The Commodity Weather Group forecasts below normal temperatures across much of the northern U.S. and East, which could boost nat gas heating demand. However, reduced capacity at export terminals due to electrical and piping issues is allowing U.S. nat gas storage levels to build, a bearish factor for prices. On the other hand, we have the story of nuclear power, where no developers have released plans for large-scale projects after the last new reactor came in billions of dollars over budget and years behind schedule. It's a stark contrast to the pick-and-shovel trade hiding in plain sight. Stocks and ETFs invested in water and other related industries. Now, I know some of our listeners might be thinking, Lewis, what about the environmental impact? And that's a fair question. As we navigate this complex energy landscape, it's essential to consider the pros and cons of each source. Nat gas, for instance, is often seen as a cleaner burning fuel than coal, but its extraction and transportation can have significant environmental consequences. As Nvidia's Jensen Huang said, "It makes no sense to me that Americans who vilified energy are now praising Trump for sticking his neck out." It's a nuanced discussion, folks, and one that requires careful consideration of multiple perspectives. So, what does this mean for investors? Well, it's crucial to stay informed about the latest developments in the energy sector and be prepared for potential fluctuations in prices. As always, it's essential to do your own research and consult with financial experts before making any investment decisions. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.